Let us leave the artificial hype, the thumbnail-clicking panic, and the overnight millionaire narratives completely at the door. We need to have a real, quiet conversation about what just happened at the absolute highest level of global financial power. Because while most people are treating this like a fleeting political drama, the reality is a cold math problem that will directly dictate the next 5 years of our financial lives. Just a few days ago, on Friday, May 22, 2026, Kevin Warsh was officially sworn in as the 17th chairman of the Federal Reserve during a highly unusual ceremony at the White House. If you look at the surface headlines drifting across social media, the narrative sounds incredibly simple. President Trump appointed a new chief, the political establishment wants interest rates to crash, and cheap money is supposedly on its way back to rescue the markets. But if you scratch beneath that glossy surface and look at the actual institutional plumbing, you realize we are witnessing an operational standoff that has not occurred in 3/4 of a century. Jerome Powell, the outgoing chair, did not do what every other predecessor has done for decades. He did not politely walk away into a lucrative private sector consulting firm or fade into academic retirement. Instead, Powell is staying exactly where he is, holding onto his physical seat on the powerful 7-member Board of Governors, where his legal term does not officially expire until early 2028. The last time we had an outgoing Federal Reserve chair refuse to leave the building upon the expiration of their leadership term was back in 1948 under President Harry Truman. Think about the pure structural friction that creates inside the single most important economic institution on Earth. On one side of the mahogany table, you have Kevin Warsh, a brilliant 56-year-old former Morgan Stanley investment banker who is openly campaigning for what he calls a complete regime change at the institution that controls the cost of global capital. On the immediate other side, you have Powell and a deeply fractured board sitting right next to him, holding immense voting power and ready to act as an institutional anchor against any sudden politically motivated shifts in monetary policy. I used to think when I was younger that these massive macroeconomic shifts were things only older people in expensive charcoal suits needed to worry about. I thought the macroeconomy was completely disconnected from my daily existence until I realized that the cost of your future home, the interest rate on your savings account, and the true purchasing power of every single dollar you sweat for is decided by the people inside that exact room. So tonight, let us strip away the sensational media commentary, let us look directly at the cold numbers, and let us map out exactly what this regime change means for our generation. Without any sugarcoating or exaggeration, Warsh has laid out an incredibly specific, four-part blueprint for his tenure, and his very first pillar is an aggressive, systematic unwinding of the massive Federal Reserve balance sheet. Right now, the central bank is holding roughly $6.7 trillion in government bonds and mortgage-backed securities, which is the heavy legacy of the unprecedented liquidity injections from the 2008 financial crisis. And the 2020 pandemic era, Warsh fundamentally believes this massive institutional footprint distorts the true natural price of capital, and he wants to take down that balance sheet by a couple $1 trillion over the next few years. In theory, he argues that reducing market distortion will lower the structural inflation risk premium that long-term institutional investors demand, ultimately creating a healthier economic environment where borrowing costs can naturally settle at a low baseline. But critics, including prominent members of his own voting committee, are absolutely terrified that aggressively extracting trillions of dollars out of the financial plumbing could cause a severe liquidity crunch, sending the stock market lower while forcing consumer borrowing costs higher at the exact same time. The second pillar of his regime change is perhaps the most shocking to Wall Street traders. He wants to completely eliminate the traditional dot plot and dramatically cut down the number of annual policy meetings from 8 down to 4 for the last 14 years. The dot plot has been the definitive, transparent roadmap that every hedge fund, mortgage lender, and retail investor used to project exactly where interest rates were heading over a multi-year horizon. Warsh wants a central bank that talks significantly less and acts with more tactical surprise, arguing that constant forward guidance creates artificial asset bubbles and an unhealthy market dependency on central bank handouts. But if the Federal Reserve completely stops giving warnings, the immediate structural consequence for ordinary retail investors will be a massive spike in daily volatility because the broader markets will no longer have time to slowly and smoothly price in policy changes. On top of that structural shift, Warsh wants to fundamentally alter how the central bank measures its primary economic enemy, which is consumer inflation. For years, the institution relied heavily on core personal consumption expenditures, an index that purposefully strips out volatile sectors like food and energy to find an underlying trend. Warsh wants to transition toward what economists call trimmed averages, which essentially cuts off the most extreme price spikes on both ends to get what he defines as a cleaner read on structural inflation. Right now, in late May 2026, consumer expectations for long-term inflation have just jumped to their highest level in 7 months, largely driven by the ongoing escalating geopolitical conflict involving Iran and the resulting severe price pressures on global crude oil markets. If the Federal Reserve changes the measurement yardstick to make inflation look lower on paper by trimming out these real-world energy shocks, they might find a convenient mathematical justification to cut short-term rates, but they risk completely breaking the public trust. And in the modern world of unbacked fiat currency, institutional trust is the only real substance backing the purchasing power of the dollar. This brings us directly to the core illusion that almost every retail investor is falling for right now. The dangerous belief that because the political establishment desperately wants lower interest rates, cheap money is arriving tomorrow morning. Let us run the actual numbers together, because the mathematics of the financial system do not care about political pressure or campaign promises. Even if Kevin Warsh and the committee decide to aggressively slash the federal funds rate at their upcoming meeting on the 17th of June, that action only controls short-term, overnight borrowing between commercial banking institutions. The interest rates that actually impact our daily survival, things like a 30-year fixed mortgage, auto loans, credit cards, and long-term business credit, are completely dictated by the global bond market. Right now, the bond market is essentially calling the administration's bluff long-term bond investors. Look at $106 crude oil, rapidly expanding national deficits, and persistent structural inflation, and they demand significantly higher yields up front to compensate for that massive long-term risk. That is exactly why the 30-year United States Treasury yield is stubbornly sitting above 5%, reaching its highest level in nearly 2 decades. When long-term government yields are locked that high, consumer mortgage rates naturally climb towards 7% and stay there, completely regardless of what the Federal Reserve says in its brief afternoon press releases. In fact, the institutional fracture inside the central bank is running so deep right now that prominent governors like Chris Waller are publicly stating that the central bank should abandon its bias toward rate cuts entirely. Many institutional trading desks are quietly hedging against the very real probability that Warsh's first actual policy move later this year might have to be an unexpected rate hike to prevent inflation from spiraling completely out of control. So where exactly does that leave us? A generation trying to build a stable financial foundation in an economic environment that changes its fundamental rules every single week. When I was 22 years old, I honestly thought building wealth meant finding the perfect high-growth tech stock or riding a highly speculative wave at the exact right microsecond. I thought I was an absolute financial prodigy who had cracked the code of the system, when in reality I was just experiencing the brief euphoria of a roaring market entirely fueled by free central bank liquidity, right before getting thoroughly and painfully disciplined by economic reality. The journey to saving my very first $100,000 did not happen because of a lucky option play or a speculative cryptocurrency bet. It happened because I stopped looking for shortcuts and embraced the incredibly boring, unglamorous laws of compounding, mathematics, and aggressive personal defense. In an economy strictly defined by a major Federal Reserve regime change, there are very clear structural losers and very clear structural winners, and we need to categorize them with absolute honesty. The absolute biggest losers in this current macroeconomic paradigm are individuals carrying variable, high-interest consumer debt. The average credit card interest rate is currently floating well above 20%, and with the Federal Reserve forced to keep capital costs higher for longer, that consumer debt acts as a wealth-destroying machine that compounds against your life every single day. The second group facing massive structural headwinds is high, multiple, speculative growth stocks and highly leveraged real estate portfolios. When the risk-free rate of return on a basic, boring government bond is sitting at a guaranteed 5%, future corporate earnings that are projected 10 or 15 years from now become worth significantly less. In today's valuation models, the era of buying a speculative company with zero real revenue and hoping for a 10x return is structurally over, because capital now has a real, painful, and persistent cost. But on the flip side of this equation, this exact same high-rate environment has created an incredible historical landscape for disciplined savers. If you are someone who has spent the last few years staying completely sober-minded, avoiding luxury consumer traps, and systematically accumulating cash, you are currently holding immense strategic leverage. A basic, everyday high-yield savings account or a short-term United States Treasury bill is yielding between 4 and 5% with absolutely zero market risk. For our generation, being able to earn a guaranteed predictable return on your capital while waiting patiently for overvalued bubbly assets to reprice downward is a massive structural advantage. The United States dollar is continuing to show immense global strength against foreign currencies, which means your true purchasing power relative to international assets and overseas travel is higher than it has been in years. Personally, I am not trying to outsmart the Federal Reserve Board, and I am certainly not betting my personal financial future on the lazy assumption that interest rates will drop to bail out mediocre investments. I am currently keeping roughly 20% of my entire net worth in highly liquid short-term cash instruments, earning a safe, boring, predictable yield completely on the sidelines. The remaining 80% of my portfolio stays strictly diversified across broad market index funds, anchored by the unshakable reality that corporate productivity and technological efficiency, especially through automation and artificial intelligence, will drive long-term human value over a multi-decade horizon. I continue to dollar-cost average into the market every single month without a single exception, completely ignoring whether the headlines on the 17th of June turn out to be wildly bullish or deeply bearish. Building long-term wealth is not an emotional sport. It is a game of simple stamina, emotional detachment, and structural defense. If you keep your personal overhead low, completely avoid the siren song of lifestyle inflation, and let your capital compound quietly in the background, the macroeconomic noise becomes nothing more than harmless background static. Thank you for sitting down with me in this quiet room tonight, and let us keep building our foundations cleanly, patiently, and logically. Let us fully understand that true personal freedom is built through the accumulation of boring, consistent days, disciplined daily actions, and mathematically sound frameworks. We do not need to accurately predict the exact path of the central bank chairman to win this game over the long run. We just need to ensure that our personal balance sheet is completely bulletproof against any storm. When the ocean gets incredibly rough, the person who survives is never the one who screams loudest at the waves, but the one who has anchored their ship deep into the ocean floor. Let us keep our focus sharp, our daily habits disciplined, and our minds entirely detached from the short-term chaos of the financial news cycle. Good night, my friends. Take care of yourselves, and let us talk again very soon.